A head and shoulders chart pattern appears as a baseline with three peaks, where the outside two are close in height and the middle one is the highest. In technical analysis, a head and shoulders describe the formation of specific chart pattern that predict a bullish to bearish trend reversal, whereas an inverse head and shoulders pattern describes the formation of specific chart that predict bearish to bullish trend reversals. The head and shoulder pattern is considered one of the most reliable patterns for identifying trend reversal, which indicates that an upward or downward trend is nearing its end. It is important for traders to wait for the pattern to complete before taking any trading decision. The reason for this is that there is no guarantee that a pattern will complete in future. A partially completed pattern should be observed, but no trade should be entered until the pattern breaks the neckline. Aggressive traders usually enter their trade as soon as the neckline breaks, while conservative traders usually wait for the price to make a pullback to the neckline after the breakout. This method is much safer since the price will typically continue in the breakout direction after the pullback. Once the right shoulder peak has formed on the head and shoulder pattern, we should wait for price to move below the neckline. Similarly, for inverse head and shoulders, we must wait for price to move above the neckline after the right shoulder is formed. In the head and shoulder pattern, the stop loss is placed just above the right shoulder after the neckline is broken, while in the inverse head and shoulder pattern, the stop loss is placed just below the right shoulder. As a general rule of thumb, the profit target is determined by measuring the points between the peak of the head and the neckline, and taking the same distance and measuring downward from the neckline. Similarly, for the inverse head and shoulder pattern, the profit target is placed at the same distance and measuring upward from the neckline.